and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I do think there is some complacency. You did see an incredible whipsaw, obviously, in the market, but also in sentiment. But even at the early April lows, you hadn't quite gotten the full washout in sentiment. You saw it in the attitudinal measures of sentiment, the survey data, a metric like American Association of Individual Investors, which does admittedly skew older on the spectrum. And you did see a bit of a washout, but it was not corroborated by behavioral measures of sentiment. What we did see, and for now it was the right move, that buy the dip mentality.
They do have some offsets, and I think that's one of the keys to the story this morning. Things like lower shrink costs, better supply chain management, that is enabling them to offset some of the higher costs that they're paying from tariffs. They're also using what they call the portfolio effect. So in general, and on average, prices won't go up, but I do think there'll be some areas where you'll see price increases, some areas where you'll see price declines, such that the average basket doesn't necessarily go up, but they can manage tariffs that way by looking at different pricing for different products.
The policies that I would point to are, on the one hand, where we see a lot of political effort, the exemptions for tips, overtime, this new deduction for seniors, deduction for auto loan interest, things that really complicate the tax code and don't necessarily deliver broad-based benefits. In fact, they are designed to be very narrow benefits.
We got 1 hour to go until the market close. Let's take a look at the major averages, sort of breaking a recent winning streak. And we saw the Dow, interestingly, take a little bit of a leg lower here as we've headed more deeply into the afternoon. Off right now about 269 points, about 0.6%. The S&P 500 had been on a 6-day winning streak. That looks like it's going to end today. You can look at the 10-day chart to see that streak, although it's kind of more gone sideways in recent sessions. And then the NASDAQ composite, there's the 10-day. Looking at today, we're down about 0.9%.
Yeah, we are taking a breather here. Yeah. It is, though, after a nice run. In fact, a 6-day run for the S&P 500. Big move off the April low, which we've talked about. You're up about roughly 20% off that. I did see some technicians today, specifically it was Piper's Craig Johnson. Mm-hmm. Craig was telling his clients, he's looking at the charts, and he's looking at the broad gauge, and he was telling them, we do look overbought here, short-term overbought. Mm-hmm, mm-hmm. Of course, Craig also told them, listen, betting against the rally has been increasingly uncomfortable, I think is how he put it.
It is interesting, though, to see this deterioration as the day goes on. So we'll see what the technicians make of that. We continue to keep a close watch on what is going on in the bond market as well, seeing the 30-year yield still hover near 5%. For the 10-year, it's near 4.5%. And just a quick check on elsewhere within the stock market and kind of what we're seeing here. NASDAQ 100, pretty red here today. We're going to get an update from the Google I.O. conference in just a little bit, but that stock a little bit rocky today, off by 2% here. And then as we look at the sectors, and where we see them take utilities and consumer staples, so a rotation into defensives today, out of tech, out of financials, out of energy and consumer discretionary.
Yeah, I'm glad we are talking about yields, because that knocking on 4.5 has been a big topic of conversation.
Yes.
What kind of challenge that potentially poses for equities?
Well, guess what? We're going to keep talking about yields right
so.
now. Long-term Treasury yields ticking higher today as investors assess the mounting U.S. debt crisis. For more on the latest bond market action, let's get to Yahoo Finance's Ali Canal. Hey, Ali.
Hey, Julie. Yeah, bond market jitters are back, and this time it's not just about inflation. Long-term Treasury yields are surging to kick off the week after credit agency Moody's downgraded its U.S. debt outlook. The 30-year yield briefly crossed the key 5% threshold on Monday. Now, this is a level that we haven't seen since 2023, before settling just below that mark. The 30-year is currently trading at just around 4.97%. Now, remember, bonds and yields are inversely correlated, meaning rising yields yields equal falling bond prices. So investors are currently selling their bonds. Typically during periods of uncertainty, investors would pile into the bond market as a safe haven, but this time around they're selling. And according to the sources that I've been speaking with, that's because fiscal fears are now taking center stage. Analysts say that we're seeing a, quote, narrative shift from positive trade and tariff headlines to rising anxiety over ballooning deficits and a potential new tax package from President Trump. He's referred to this as his one big beautiful bill, and that proposal could add as much as $4 trillion to the national debt. So it's this growing uncertainty that's pushing what's known as the term premium higher. Now, the term premium, it's basically the extra yield investors demand for holding long-term bonds in a risky or uncertain environment. And if we take a look at short-term yields, so think your 2 and your 5 year, those have stayed relatively stable given the Fed is widely expected to hold interest rates steady. But it's the back end of the curve, your 10-year, your 30-year yields, those are the ones that are climbing fast. JP Morgan analyst Kelsey Barrow told me that the steepening yield curve looks a bit different compared to historical norms, primarily given the fact that it's been driven by a lot of these fiscal and policy unknowns. And with recession fears, credit downgrades, and fiscal gridlock all in play, some global investors are starting to look elsewhere for more attractive returns. So current policies like tariffs, for example, making it that much harder to attract foreign buyers. And those buyers are likely going to demand higher yields to offset those reduced inflows, which will push that term premium higher. So Josh, Julie, it's basically this ripple effect that we're seeing here. But that 5% point that we hit with the 30-year yield, that was a critical technical milestone that a lot of analysts have been referring to. So we'll continue to watch those to see if we tick even higher.
All right, thank you, Allie. Well, stocks slid on Tuesday, pulling back from their recent rally amid growing warnings that investor relief over cooling in trade tensions and U.S. inflation may be misplaced. For more on the latest market moves now, let's welcome in Megan Horniman, Verdant's Capital Advisors CIO. Megan, it is good to see you. Maybe, Megan, we'll start right there with what our colleague Allie was just talking about, which is these moves we're seeing in the Treasury market. Megan, I'm looking at the 10-year here. Your benchmark is knocking right at 4.5. I'm curious what you make of those moves, Megan, and what kind of challenge, if at all, that poses to the equity market.
I think you're seeing it, this week. The challenges it poses is those areas of the equity market that are trading with very high multiples. When you talk about that, you're looking at technology, you're looking at growth sectors. These don't like spikes in interest rates. So I think if this continues, especially in the long end of the curve, that does keep some more downside pressure on those areas of the market.
Megan, it's Julie here. Do you think it will continue? I mean, it's so interesting, this whole debt question, because it sort of rears its head now and again, and then it seems to sort of recede. I'm not sure what would change that would make it more alarming, I guess, in terms of the reaction we'd see in the market. What do you think?
Well, I think what we need to see is get some more auctions under our belt and make sure that these auctions go off successfully. These auctions will be paid very close attention to, primarily the longer term auctions. So think about your 10-year and your 30-year. If we can consistently get those where we're not losing international demand, I think you can get some cooling in that concern, because you're right, the deficit has been the deficit. Our debt has been our debt for a long time. And I think it's just kind of coming all together at the same time while the government's trying to get what could be a $5 trillion tax package passed through. So we've seen this before. We've been here before when the credit rating got downgraded in the U.S. It did have some short-term impacts, but if you look over the next 9 months, 12 months, not really much impact even in the fixed income side of the world.
Megan, you mentioned that Trump tax package. If those Trump tax cuts do get extended, Megan, how do you try to think through as a strategist what that means for the market?
Well, I don't think they're going to get extended in total, and I don't think you're going to get that the $5 trillion that they're saying this may add to the deficit. I think what we're seeing here is a lot of this, political wrangling going back and forth, where they can cut something in order to get something going forward. But I do think with the economy slowing, that some form of tax cuts and some form of the extension of the Tax Cuts and Jobs Act is good for the economy. I do think that long term that keeps us optimistic about the equity market. But right now there's just so much uncertainty, and we're kind of in the midst where the economy is really, really starting to slow down.
And so what does that mean for positioning, given that slowdown? I mean, I guess there are sort of maybe some sector things that could be affected by the tax bill, however it ends up. passing, but where are you sort of counseling clients to go right now?
So we're being patient, and when we've seen some of these pullbacks we've had in the market this year, we've had some dry powder to put to work, and we have been taking advantage of that. Even though things looked really scary after Liberation Day, and everybody was concerned we'd have this much deeper trade war that would go on for a prolonged period of time, that was just not a realistic viewpoint. So we took advantage of some of those big pullbacks in the market to add to not just U.S. equities, for example, small and mid-cap, U.S. value equities, but don't forget about the international markets. This is where you can add that diversification, and you should have that diversification in the portfolios. I think if you look at the U.S. markets compared to the developed international markets, they've outperformed for so long that the developed markets, even though they've done better this year, over a long period of time, they're still very attractive to have in a portfolio.
Megan, you note another theme, which is this idea of Trump's agenda, Megan, and how it caused concerns about investors pulling out of the U.S. Are we seeing signs of that, Megan?
No, not yet. And if you look at the auctions that we've seen since Liberation Day, you're not seeing any change in, I don't want to say anything that's cause of concern for the auctions. They've all gone off pretty well with pretty decent indirect bidding participation. Now, we got the most recent tick data, and that was from March, so it comes out with a big delay. But we're looking at foreign holders of U.S. Treasuries that are record high. So as of right now, we're not seeing it. We'll watch these auctions, and we'll also watch that tick data as we get it after the Liberation Day, after that April announcement.
What about as it pertains to stocks? Because we have still seen, despite the bounce in U.S. stocks, if you look at the year to date, international stocks are still outperforming them by the widest margin that we've seen in a while. Is that an area that you think investors, you talked about diversification, is that one of the areas that they should be in?
In the international side?
Yeah.
Yes. I think I would be cautious about the emerging markets right now because the emerging markets, over a very long period of time, you should always have some exposure to the emerging markets because they are growth engines of the world. But right now, there still is a lot of uncertainty from that trade side of the equation, and their economies are very reliant on this trade. So focus on the developed internationals. Think about Europe. Europe's been spending a lot of money on their economy. They've been able to be flexible with their monetary policy more than we have been able to. So take a look at some of those investments as well.
Megan, thanks so much. Appreciate it.
Thanks.
The Google I/O Developer Conference kicking off today, and some news coming out of it, including a partnership with Warby Parker that is sending those shares higher by 16%. Joining us on the ground with the latest, Yahoo Finance tech editor Dan Halley. I know these things can be sort of a fire hose of announcements, but give us some of the high points there, Dan.
Yeah, Julia, fire hose might be underselling it, actually. We saw a ton of announcements from Google today, too many to really recount. So we'll just go over the top three. And the number one is how Google is kind of evolving search over time. They're bringing more features to its main search offering, a new feature called AI mode that they were testing previously, but now is going to be available to all U.S. users. And you can think of it kind of as a ChatGPT style version of Google search. They have a deep search where you can do a lot of research. There's a number of features up top with the Google smart glasses and Warby Parker. That's why those shares are changing. Really, what they're saying here is, look, we have this operating system called Android XR. You can see a demo of it here. This is where they would be doing live translation, which we saw some of on a demo on stage. But they showed off a working version of this during the announcement. It really does seem like an incredible product. The person who was demoing it showed off the ability to do this exactly, looking around for directions, how it's context aware, things of that nature. Warby Parker, Gentle Monster are two of the companies that they're going to be working with, as well as XReal. They have a prototype that they've already shown off, or product that they've already shown off using Android XR. And then we have that agentic AI, that's part of that AI mode where you'll be able to do things like basically tell a product, the search, to go ahead and look for a specific product for you, set up the price range that you want, the size you want, the color you want, and it'll go ahead and basically buy that for you. It'll go through the whole process up to the point where you would press purchase and then go ahead and do that. And then there's also this idea of a I just thought it was interesting, virtual try on. And so you'd be able to virtually try on clothes that you would see. And that's what you're seeing here, where, I could say, okay, show me a suit in blue. Oh, I like this one. Let me see what it would look like on me. And then it would be able to do just that. And we saw a live demo of it as well. It seems really incredible. I think the one caveat to point out, though, is it doesn't get sizing, specifically when it comes to showing what it would look like on you. So a large versus a medium, depending on your height and weight. So it's not there yet. But when I spoke to Google earlier this week, they said that they're working on those features down the line. So a huge number of announcements here at I/O, and really, this is Google's attempt to try to reestablish itself or kind of show that it hasn't lost step in search or AI.
Yeah, Dan, you're kind of leading me where I wanted to head with you, which was the big question, Dan, hanging over the company, and we've talked so much with you about it as well, is this question of AI and just what it means for search, Google's bread and butter long term, given these emerging popular alternatives. And I know, we've certainly had plenty of analysts on the show who are bullish on the name, and they'll certainly hammer home the point that Google is not standing pat, they're not sitting still, they are innovating. But I'm just curious, high-level thoughts, what more line of sight you think we got into that very central foundational question today at this conference?
I mean, clearly they're moving this kind of AI mode idea and AI overviews front and center, right? The AI mode is really it's a rival to ChatGPT, to Perplexity, those kind of chat-based conversation-like search engines that you have. That's where it looks like Google may want to head. Now, the other part of that is the agentic AI, where I was explaining how it could go through and help you purchase things or look up tickets for a Mets game, for instance. You would be able to go through and find the price that you want. It would be able to find those for you. So it's these two kind of elements that Google is really leaning into, kind of to get away from, not necessarily get away from, but to show that it's advancing beyond just the standard search box. And I think, that leads to the question, okay, well, what does that mean for companies that depend on Google for those blue links, or whether it's page views or servicing relevant information? AI mode, one of the demos they showed was looking for restaurants. What does that mean for companies like Yelp and beyond that?
Thanks so much, Dan. Appreciate it. We're just getting started here on Market Domination. Coming up, Elon Musk isn't going anywhere at Tesla. The CEO of the EV maker has recommitted himself to the company. We're going to talk to an analyst on the other side to discuss what is next for Tesla. And at 3:30, it's the return of everyone's favorite series, Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stay tuned, much more Market Domination still to come. Tesla shares in focus today as CEO Elon Musk said that the stock price shows the company is in a good place. He said he's committed to still be Tesla's CEO in 5 years. For more on the latest from the EV maker, let's welcome in Jed Dorsheimer, William Blair Group Head of Energy and Sustainability Research Sector. Jed, it's good to see you here. Now, this seems to be, rather than a pivot point for Musk, this seems to be sort of the last point in his recent pivot, if that makes sense. In other words, he sort of has made a recommitment to the company. We've seen that on the earnings call. We've heard him talk about it. And then this latest comment just sort of seeming to solidify it. Is that how you see it? And is it a positive for Tesla?
I think it's always been solid. I don't think that Elon's commitment has wavered at all in terms, I think there's been media around that, but I think what it does, though, is it reinforces, if you look at the value of Tesla, I've said this, that if you look at Tesla and you say it's just an auto company, well, then it would be, significantly overvalued, right? It would be a short if you looked at it from that perspective. Tesla is a juggernaut of innovation. And at the heart and central to that has been Elon, is the steward of that ship. So what we got today was kind of that affirmation from Elon that he's not going anywhere. And I think as the company looks at morphing once again in terms of the product portfolio, and the drivers to this business, I think that is critical to make sure that he is going to be the one at the helm.
And speaking of Tesla innovation, Jed, robo-taxis on the way, right? I'm curious, as an analyst who knows this company very well, when you think about that broader robo-taxi market, Jed, what it is, what it could be, how do you sort of compare and contrast Tesla and Waymo in that market?
It is a good question. I mean, our focus on Tesla has been on the energy side of the business, which is 14% of sales, but 25% of the profitability. And I think we've been pretty right on that. The robotaxi has kind of been this moving target, for the past few years. And now we're really coming to the point of launching the beta in Austin, Texas. And, I think there are probably ways that Tesla can have an advantage in terms of that true vertical integration, which Waymo doesn't have. And the counterpoint between the two has been whether LiDAR versus camera. And I think at this point, from a scalability and a cost perspective. And so the ability, if Tesla can prove out robotaxi successfully with the visual versus the LiDAR system, that means that the profitability for Tesla is going to be far greater than what Waymo would be able to achieve. But that is a risk factor around both of them, and we have yet to see Tesla kind of prove that out in the real world. So this is going to be critical for the future of Tesla's business model. And
that's because the camera system is less expensive than the LiDAR system, Jed?
Oh, yeah. So I think the cost structure is, like $100,000 for a Waymo, compared to, so it's fractions. It's would be pennies on the dollar in the comparison. So that gives a, major advantage to Tesla, as long as they can kind of prove out that the neural network has the efficacy and the safety associated with that.
Jed, let's say that EV tax credit, Jed, goes bye-bye. That $7,500 gets repealed. What does that mean for Tesla?
Well, the stock would go lower, in my opinion. That will have a margin contraction, and so that is the other risk that's on the table as we go into, moving over to robotaxi. Because if you get rid of the tax credit, that's going to be a headwind on overall EV demand in the U.S., and that would hit the margin structure, because autos still are the largest product on the business model. So if that is if you have high conviction that is going to go away, and that then there could be volatility and an air pocket before you get to. We see the robotaxi ramp.
All right, good to know. Lots of stuff to watch when it comes to Tesla. Jed, thank you so much.
Thank you, guys.
Now time for some of today's trending tickers. We'll check in on shares of vaccine makers as well as D-Wave Quantum and Viking Holdings. First up, we've got Moderna, Pfizer, other vaccine makers getting a lift after the Food and Drug Administration provided new regulatory guidance for COVID boosters. It's going to limit future COVID vaccines to older and at-risk Americans, and won't recommend the boosters universally as well. There were concerns that the new rules would be more stringent for vaccine makers, and so that seems to be why largely they are rallying in the wake of that.
Yeah, so it sounds like, okay, this would add a costly requirement, but the shots would still be available, at least for high-risk folks, and that I guess was a relief, because the concern, to your point, Julie, was, wait a minute, this is a whole wave of restrictions coming, so some relief there. I did see Bloomberg analysts saying the new FDA guidance may be a silver lining, they said, for COVID vaccine makers, could increase the use of shots, given how many folks have other health conditions, was their point.
Right, and basically a lot of the sentiment surrounding this FDA with HHS above it is that in general they're not going to be friendly to vaccine makers. So we've gotten some developments, including the Novavax approval that maybe is causing some relief broadly for these types of companies.
All right, another name here. Shares of D-Wave Quantum soaring today on the release of its latest quantum computing system named Advantage 2. So this one moving higher. D-Wave Quantum shares tacking on nice gains, announcing the general availability of its Advantage 2 quantum computing system, saying so powerful apparently that it can solve hard problems outside the reach of one of the world's largest exascale GPU-based classical supercomputers. Remember, it comes after, and I think we talked about this, Julie, last week. Quantum computing post results last week. Talked about entering 2025 with strong momentum. So seeing some of these names get recent lifts.
Yeah, I mean, this is a very heavily shorted name. We should mention 21% of its float is sold short, according to data tracked by Bloomberg. So you are likely seeing a short squeeze, at least in part. But we know there's a lot of retail interest in these quantum names, and so they tend to be pretty volatile on headlines like this.
And by the way, all 6 analysts who cover this one say it's a buy. No holds, no sells.
Wow.
Yeah, across the board.
Shares of Viking Holdings as well, a cruise company, falling today despite a strong first quarter earnings report. The company's 2026 booking rate slightly lower than the same period last year. The company's revenue in the first quarter was up 25%, and it said it was seeing strong demand for its European trips. Viking, primarily known as a river cruise company, but it does have some ocean cruising as well. It said 37% of its capacity is booked out for 2026 , but it looks like that number is something that investors are focusing on.
I mean, executives saying, sounds kind of confident tone. They said, talked about seeing sustained strength in demand. They talked about 92% of 2025 capacity already booked, how effectively selling out the year, given our typical load factor. Jefferies, to your point, did say, Julie, Wall Street may see 2026 bookings of 37% as a slight disappointment, and that's what it looks like, down about 6%.
And just wanted to mention as well, remember, this company just lapped its 1-year anniversary as a public company, came public in April of last year at $24, trading above 40. So you've still seen a positive return on your investment if you got in there.
All right, plenty of economic headlines this week. The market's still digesting the latest credit downgrade from Moody's and a looming House vote on deck for President Trump's tax bill. Here to help us break it all down is Citi economist Veronica Clark. Veronica, great to see you. Maybe we'll start on that Trump tax bill. The president was on Capitol Hill today, Veronica, kind of rallying Republican lawmakers, trying to behind his agenda. Those Trump tax cuts, if they get extended, Veronica, walk us through as an economist how you would see that, how you'd model that, its impact on the U.S. economy.
Yeah, absolutely. Obviously, still a lot of moving parts. This has to pass through the House, and then the Senate will take over and probably make some changes. But the first way that we think about the economic impact is really just look at what does it do to changes in the deficit. Of course, the deficit has been pretty wide for the last couple of years. We're around 6% or so of GDP. And this bill looks like it will keep that maybe around flat. Maybe, if anything, deficits could be slightly wider. That would be more expansionary fiscal policy. But overall, we're expecting pretty much flat, still, of course, very wide deficits. But for growth, that means a pretty flat impulse.
And Veronica, at what point do those deficits, and perhaps more pertinently, servicing the debt, for example, at what point does that become an economic problem? Or does it not, as long as foreigners keep buying the debt?
Yeah, I think in the near term, it is sustainable enough as long as there are people willing to buy. Of course, yields are relatively high, so maybe it is an attractive buy. But yeah, we would get, of course, increasingly worried, and the yield issue is part of that. Debt servicing costs, interest expense is going to be an increasing part of this deficit. And yeah, at some point you do worry about that, and we don't really know when that bites, unfortunately.
Veronica, switching gears, I also want to get your thought on tariffs. Obviously, a lot of dimensions to that policy tool. As an economist, how are you thinking through it, Veronica, its impact, for example, on inflation?
Yeah, absolutely. We did have last week the delay of those substantial tariffs on China, now 145%. As of a couple weeks ago, that was prohibitive for trade, essentially. And now the tariff increase on China is something around 30%, which is doable, but it's still large. That is still something that probably gets passed on to consumer prices, maybe not quite as much as we were expecting. But right now, the Fed's preferred inflation measure is hanging out around 2.5%. That's core PCE inflation. inflation. We think by the end of the year that could look something closer to 3%. And maybe we start to see that in consumer prices as we get to the late summer, early fall. We haven't seen it so much yet in some of the inflation data we got last week.
With those tariffs, Veronica, let's say, to your point, let's say companies decide, we'll eat some of these costs, but we're going to have to pass some of them along. Is the American consumer in the financial position right now, Veronica, to shoulder those costs?
Yeah, I think there were a lot of signs before we got to the tariffs, the risks for this year, that the consumer was weakening. Consumption could be slowing. It's held up pretty well. Of course, consumer spending has been a big driver of the economic strength the last couple years. But I think that's reflecting that layoffs are still low. The labor market has been healthy enough. If something changes that, which tariffs could be a factor in maybe seeing some layoffs later in the year, then this does look like a really vulnerable consumer. Savings rates are very low. Delinquencies are pretty high. Debt repayments, we're having student loan repayments starting soon. All of that could weigh on consumption.
And Veronica, the Fed folks that we've heard from speaking today, Bostic, Musalam, both kind of saying, we still have to wait. We don't know what effect the tariffs are going to have on inflation or on consumer behavior. I also saw a headline from Ray Dalio speaking at a conference today, of Bridgewater founder, saying the Fed's in a difficult position and shouldn't cut rates. Is the Fed effectively frozen here for the near term?
I think for the very near term, yeah. I think we're all a little frozen. We're just waiting for the next data point to see what breaks first. Is it do we see higher inflation first? Do we see a weakening labor market first? I think eventually we will see signs maybe that the labor market is starting to weaken before we see concerning signs of price increases. As we're getting into the start of the summer, this is a time of year the last couple years where the unemployment rate has risen because we have had a loosening labor market driven by very low hiring. And that hiring issue could look even worse this time of year, this year because of uncertainty. So I think we will see signs that the labor market is slowing as we get into midsummer. Maybe that allows the Fed to cut. But for the next, couple months, they're probably on hold.
Veronica, great to have you on the show today. Thanks so much for joining us.
Thank you.
And coming up, it is the latest edition of our series, Goodbye or Goodbye. We are taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stay tuned, much more market domination. So,
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a look at growth prospects for some NASDAQ names. I'm here with Commerce Street Holdings CEO, Dory Wiley, who is here with us in the studio. Special treat, because usually we talk to you remotely, Dory. So thanks for being here. Let's get to the stock that you like. It is called Enterprise Financial Services. It is a regional bank based in St. Louis. We're looking at the one-year chart here. And over the past 1 year, it's actually up 36% or so, although it's dipped a little bit this year. So let's get into it and why you like it. First of all, you say it is undervalued growth here. Talk me through what that means in this case.
Absolutely. Investors are always looking for growth at a reasonable price, right? And that's what this stock gives you, especially in the banking sector. It's a very solid company. They've got really good growth, 15 to 16%. Tangible book value per share or earnings per share growth, year in, year out. And they've just got a great track record of it. And they're only at 10 times forward PE, which is much below its peers. So it's got a faster growth rate than its peers. It's a great value.
Gotcha. Even with that rally, still at that 10 times. And when you look at the margins, and talking about a regional bank, some of them are really indexed to loans or really indexed to the consumer, but you say this one has diversified revenue. So what does that picture look like?
Well, they're also in wealth management and other sources, and their loans are very diversified. Their loan book is much diversified. So some banks are over-concentrated in real estate or commercial or whatnot. They're extremely diversified. And that's key for banks because they're levered institutions and everything's about credit. This bank's got a great credit underwriting group, and yet they have above margins, well above margins for their peers, and this diversified revenue. It makes them a safe choice in banking, which is key because they're cyclical.
Gotcha. All right. And then finally, defensive positioning here within the assets that they hold. So what does defensive mean in this case?
Okay, so I just talked about it being defensive on its credit underwriting.
Yes.
Balance sheet structure. they have a way above average amount of tangible equity capital, above 9%. JP Morgan, for example, runs maybe 7.5%. So this is a very safe bank, yet it's growing. So think about when things get ugly. Let's assume that there's a recession. Other banks have to pull back. This bank can not only expand, but it can define credit terms in the market. That makes it a really good all-weather stock up and down market.
And just curious, it's not on our 3 points here, but where is that growth coming from for the bank? Is it in loans? Is it in wealth management? Is it all of the above?
It's all of the above. They got great 8% loan growth year over year, so it's consistent and not exorbitant. But the markets they're in, it's not just a St. Louis bank, it's in Texas, it's in other markets in the South. And so it's growing actively in those markets and good markets that have growth.
Gotcha. So even for these picks, we like to say, well, what could maybe go wrong or what's a risk? You say an industry cyclical trading out of favor. So what does that mean?
The biggest risk to this stock is not the company itself, it's the sector, it's banks.
Gotcha.
So the stock could go down. I think you just weather it or you buy more.
Gotcha. All right, now let's get to the stock you don't like as much, and that is Wingstop. Good thing we're past the thick of football season, although I guess wings are an all year round item here. Now this stock is down about 14% over the past 12 months, but it has bounced a little bit year to date to some extent, just as with this latest move upward here. But contrary to your other pick, you say this one is too rich for your blood.
It's almost just the opposite of Enterprise Financial. This is a wonderful company and a wonderful management team doing a great job. So I'm not stepping on the company. It's the valuation. The valuation's at 65 PE at an 18% growth. And we just talked about a company that 10 forward PE at 15 to 16% growth. I think that's too much, and you don't see that in restaurants. And they've talked about, a slowing growth rate, slowing metrics. So this metric is just way too high for what it is.
Right.
Nothing against the company, it's just the stock.
Gotcha. Okay, but let's talk about that growth piece of it that you just mentioned here. In a time when the consumer sentiment surveys are not looking so great. So what's the growth profile here?
If anything goes wrong, this stock is in trouble. It is a prima donna stock. Everything's assumed to go correct. Well, last year had terrific growth. It's done terrific. It's gotten efficiencies. They're very AI driven. Their kitchens are super efficient, but there's not a lot of room for same store sales growth, which they even forecast to be way low this year compared to what they've had in the past, yet the stock hasn't priced that in.
Gotcha. And then finally, overbought signals. Now, as I mentioned, the stock's down over the past year, but it's had a pop year to date. So has that pushed it into overbought? It's sort of a
It really has. It came up over 54% in the last 30 days.
Wow.
Sell it. Take your profits. Go somewhere else and buy something else and wait for this to come down again.
Okay, so when we talk about what could go right, I guess it's waiting for it to come down again. If it comes down, how far would it have to come down? What other signals would you be looking for to maybe step back in?
I would like to see, it ought to be at least a 20 to 30 forward PE, because they plan on opening plenty of more stores. That same store sales growth is going to be tough. They could get it in the new stores, right? So if they can keep that pace going, then they're going to keep a higher than average PE, but it shouldn't be 65. So maybe it gets in the 30 to 40 range or something. I'm all over this stock.
Gotcha. All right, Dory, thanks so much. And just quickly, do you have a position in Enterprise? You hold Enterprise?
Definitely hold Enterprise. We're bank investors, and I don't have one in Wingstop, but I did eat some dry rub wings last night.
All right. That's the best disclosure we have ever gotten, Dory. And Dory's going to stick around and join us a little bit later for a broader market chat as well. Thanks so much for watching Goodbye or Goodbye. We'll bring you new episodes at 3:30 p.m. Eastern. Solar stocks have been in focus this week as President Trump's tariffs, as well as the debate over the tax bill in Congress, cast a cloud of uncertainty over the industry. We're navigating how to play the solar sector with the Yahoo Finance playbook, and joining us now to shed some light on the sector is Dimple Gosai, BofA Securities Clean Energy Analyst. Dimple, thank you so much for being here.
Thanks for having me, Julie.
So, yes, there are the tariffs, which some of them benefit and some of them don't benefit different parts of the industry, so that's a little complicated. Then you also have Republicans pushing to phase out some of the credits in the IRA. I guess let's first take big picture. What is the biggest potential risk for the industry in all of this policy talk?
Well, let's start with the good news. IRA full repeal is off the table for now, which is why you saw the price action that you did this last week, right? I think the market had priced in some uncertainty whether we might see a full repeal or otherwise faster phase down 45X tax credit, which is the advanced manufacturing tax credit, which is core to some of the key equipment manufacturers, be it for solar, which is 50% of our price objective today, or whether it comes to trackers and some of the inverter players, 45X is key. So there was some uncertainty whether that would be repealed or not. Good news is that it's intact. There's some faster phase out, which is meaningless, or I would say pretty benign as it stands, but there could be changes made, right? Transferability, question mark as to how that goes. It was a bit of a big surprise there. And then safe harbor too, big surprise. So a lot of the details are still being sorted through. But as it stands, I would say net, it turned out to be relatively positive.
What about tariffs, Dimple? Broadly, what are the downstream effects for the sector?
Well, from a tariff perspective, look, I think, as it stands, there's a lot of moving pieces. It's pretty binary for a lot of the stocks. Today, if I think about Chinese tariffs, that is super important for the battery supply chain, right? There is just, you think about LFP batteries, 90% of that is sourced from China. That's an industry killer, for example, if we don't get, a reversion to, something that's more reasonable. As it stands, 145% is on pause, obviously. And so economics tend to work under the current tariffs of 30% on China for the likes of Enphase, to some extent Fluence. But if we were to see that north of that 30% back to 140% or so, this does have a big implication for margins, the ability to pass through those costs, and ultimately end demand.
And Dimple, we talk about the solar stocks as a monolith, but they're not. They're very different in terms of what they do. So let's look at it through the prism of two stocks, one that you like, one that you don't.
Yeah.
First solar that you like, Enphase that you don't. Now, these companies are in totally different parts of the chain. For people who aren't familiar, explain to them where they each sit.
Good question, right. So for solar, I call them simply the domestic king, right? They use cadmium telluride technology, which is not reliant on crystalline silicon, which is a Chinese technology, which basically insulates it from any type of tariffs that are being implemented. So First Solar has been a long-time beneficiary from things like anti-dumping and countervailing duties, otherwise known as AD/CVD, and now more recently, these tariffs that have been implemented across the market. Now, I won't completely negate any impact to First Solar because they do have about 7 gigawatts of nameplate capacity outside the US via Malaysia and Vietnam, where we have seen some reciprocal tariffs, which are now on pause.
Right.
But to the extent that, the universal 10% tariff stays in place, management have highlighted a great initiative or strategy of almost moving that capacity back to the US, right? Doing that will enable them to capture over $500 million of 45X tax credits. So, I think they leverage towards domestic policy tailwinds, which has benefited them tremendously. And the fact that, through the IRA, we're talking about a foreign entity of concern provisions, which basically prohibits, any new cell capacity from international players entering the market, gives First Solar further runway to compete, in our view.
Gotcha. So you have First Solar, the domestic panel manufacturer. Then you have Enphase.
Correct.
Which sits in a different part of the technology stack.
Right. So Enphase, think rooftop solar, right? Inverters,
And they don't make the panels. They make the tech that transfers the energy to the house.
Exactly. Okay. You said it best. So Julie, look, Enphase is exposed to a different set of macro drivers, right? I think residential solar has seen a market that's deteriorated 30% in the US last year. This year, market expectations, were up 20%, now recalibrated down to flat to down, actually. And tariffs just complicate the matter further, right? And this is why I think one is residential solar has seen weak demand, right? In the US, and Europe. Higher interest rates don't help them. NEM 3.0 policies are further complicated or causing further risk of adoption, especially for loan-based installments. But then the tariffs is where it really gets juicy. Now, we spoke about some of the draft bill provisions earlier on, and 25D is the tax provision that enables homeowners to capture 30% tax credits to lower the cost of their solar system, right? That basically ends at the end of this year. What does that mean for volumes, right? Net, it is a big, it has a big impact for end demand. On the tariff side, now, battery storage was always the sweet spot. We kind of argued that, hey, look, new battery adoption, new technologies here would likely see TAM expansion for Enphase because, more storage adoptions means that, we might see more growth on the microinverter product. But like I said earlier on, all of these batteries are coming from China.
Right.
So to the extent that we see a 30% rate or we see the reciprocal rate, it's a question mark. Today, Enphase has guided margins down, 2% this past quarter, 6 to 8% in Q3, as they look for new supply chain partners, right? So whether that margin deterioration is structural or not is yet to be seen.
Dimple, great to see you and to have you on the show today. Thanks so much for your time.
Thank you for having me.
And while we wrap up today's Market Domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.